Bob, welcome to the podcast.
Well, thanks for having me on here.
Well, Bob, I'm excited to have, and I feel like I'm really rounded out the heroes of retirement research now. Yeah. We've had Dr. Pfau on a couple of times. We had Alex Murguia on here just a couple of weeks ago. Now we've got Bob joining us, and you're bringing a different element to retirement researcher. I think the three of you might be called the Three Musketeers. You all bring something different to retirement research. And I think it's really beautiful how you all have different opinions and you view things differently and you collaborate in order to deliver people the latest, I think, truly unbiased knowledge that's out there. I find that so much of the retirement research that's provided isn't really research. It's more opinion-based, and there's a lot of bias that's really serving the interest of the author rather than the end user. And I think you have done a wonderful job of really showing up in an unbiased way and really taking a much more academic approach. I want to talk about right off the top here what you're really aiming to achieve at Retirement Researcher personally. You joining Retirement Research as well as McLean. You said you joined McLean for one to continue working to understand how investments fit in the broader retirement income paradigm. And some might look at that and go, why is that such a big deal? Why is that standing up to Casey? Like, that stands out to me because I think most look at investment planning and retirement planning as much the same thing. Mm-hmm. And maybe I can play devil's advocate here and have somebody that might approach us and say, well, aren't retirement planning and investment planning the same? So I want you to answer that. What's the difference between retirement planning and investment planning? How are these not the same thing?
Right. So what I would say is investment planning is a piece of the puzzle. So no one invests, or very few people, I'll put it that way, invest just for fun to see the numbers go up. It is fun to see the numbers go up. We're not seeing that much this year, but the point of investing is to get you to the retirement that you want. It's to get you to the place that you want to end up. And it's just a tool to do that. There's a number of different other ways that you can be looking at the problem or bringing different solutions to bear on that problem. It could be, more focused on, annuities or more safety first type approaches. It's all about the end goal. And investing is just one very powerful, but just one tool.
So are you saying that it sounds like you're saying that investing is the accumulator's one tool, but then you get to retirement and that changes?
Well, a little bit. So you're absolutely right. For the accumulation stage, it's really, no matter kind of where you fall out on the safety first probability spectrum, your big tool really is going to be the investments. Though I do want to stress that in accumulation, for most people, assuming you're not just about to retire, the most important number in your retirement plan is your savings rate. As long as you're not screwing up your investments, if you're saving enough, it's probably going to work out. Once we get to the distribution phase, once we actually get to retirement, or more specifically, you start taking money out, you start spending out of your assets, then, your investments are still very important because that's still the growth engine within your plan. But, it's definitely a change from the accumulation stage.
Well, and give us a bigger picture of what retirement planning really is. What are those other tools that fit in that box of a retirement plan? What makes a true retirement plan outside of investments?
Yeah, so there's a lot of different pieces that are going to fall into this puzzle here. So like I said, investments, for a lot of people, it's probably one of, if not the most important piece, but those other pieces have a big impact. So you want to be thinking about things like your reliable income. So that's both annuities, bond ladders, optimizing your Social Security, claiming strategies. You're going to be looking at tax planning and charitable giving planning, all of that type of stuff put into the mix there, as well as also thinking about what you want your distributions to look like, as well as planning out how much and what do you want to be spending through time, and how do we take that money out, as well as the broader kind of just management of all of this type of stuff. So we can obviously go a lot of different directions there within each of those sections, but it's really going to be that mix of all of that type of stuff put together and figuring out what's the mix, what's the set of trade-offs that works best for you and your retirement plan.
I think that mix, the whole mix of this creates a lot of challenges for the average individual that's stepping into retirement. And I want to talk about one of those challenges that I think comes up quite a bit. You and I have discussed this in the past. You've had this question asked of you over at McLean Asset Management. And I would like the audience to hear how you handle this question. Do you have individuals, let's pretend that I don't know the answer to this, but do you have individuals that come in and visit with you and they want to know, well, what are the average returns of your clients? What are the average returns of your clients? What are they trying to accomplish, right? They want to know, are you doing better than what I'm doing? How do you handle that question and how do you think about it?
Yeah, well, we've been getting a lot more of those questions lately than we did 2-3 years ago. I'll put it that way. But, what we really stress is that every client is unique. We're happy to tell you what the returns are on our model portfolios. And you know what? The numbers are what the numbers are. But what we really stress is that every plan is unique. So, even if you're in a model portfolio and we haven't customized it for, and this is obviously with my McLean hat on, which is a separate company from Retirement Researcher, but even if we haven't customized a client's individual portfolio from the model portfolio, that's going to be sitting within the context of their plan being different from everyone else's. And, the ordering of their savings or their distributions. What does the rest of their reliable income look like? All of these different things are going to have massive impacts on the totality of the success of their retirement plans. And it's really going to come down to, we'll obviously also have a philosophical discussion around, here's why we invest, here's how we invest, all that different type of stuff. But it's really going to come down to, we got to look at this holistically. Nothing is done in isolation. And, everything else that's going on beyond the investments is going to have a really, really big impact here.
Well, and I think most individuals, as they're going through that accumulation stage, maybe they're working with someone that is purely an investment manager.
Yep.
And I think that's most common. And there's even, some of the largest investment managers out there today, they might only manage one portfolio. So it's easy to ask and easy to answer, well, what are your returns? Well, these are our returns because we have this one strategy. Everybody fits into this growth bucket. But then we get into retirement. And as you said, it's not all about investing anymore. So there's a lot of other different tools that go in there. And some of those assets get allocated to other places, right? We're talking about healthcare strategies, legacy strategies. We talked about charitable strategies. Well, then there's going to be significant variance across all of those different returns, depending on how much emphasis you place on legacy, how much emphasis you place on growth, how much emphasis you place on income, and how much income your strategy actually needs. And all of that can become very overwhelming because you approach this in your whole life just thinking about returns and investment management. Well, now I have to think about all these other elements. How do you reduce overwhelm for families when they come in to start structuring a retirement strategy? When you come in and say, well, it's not all about investments, like all these other things we got going on.
Yeah. No, so it's depending on the specifics of the situation, it can get very, very complex or very, very simple. We always start with the RISA. As you guys have been talking to Alex and Weade, I'm sure you've been hearing a lot about the RISA. And we start figuring out. We
just started using it. I think our one of our leaders, our CIO, has a conversation with Alex today about RISA and further integrating it into our process. It's a beautiful thing that you guys have created. I'm really excited.
No, and one of the great things is it really helps clarify, not necessarily the tactics that you're using, but it clarifies the things that you're thinking about. It clarifies what's important to you in terms of your retirement spending kind of strategy, your retirement spending, well, personality. And once we have that, we can really kind of backfill what's going on with the rest of the plan. How do we get you to the place that you're comfortable with? Because, everyone always talks about discipline in investing or retirement planning or anything like that. But discipline is kind of an outgrowth of building a plan that works for you. You can build the most beautiful investment portfolio. But if someone isn't comfortable investing, if they're not comfortable building their retirement plan around their investments, it doesn't matter. They get to a couple bad years and they're going to bail because that plan's not built around them. On the other hand, you can design, the most elegant safety first type of plan. But if someone is more on that total return type of side, they want that probability, they're comfortable with that level of risk, they're really going to chafe at kind of the set nature of a lot of those reliable income type of strategies. So what you got to do is talk to the client, talk to yourself, and really start sorting out what's important here. And then you backfill from there. So, the investments, they can be dead simple. Some total stock market fund, throw in some international stuff and a bond market fund. You're done. You just got to figure out the ratios. That's easy. What you also want to be thinking about is kind of that tax planning and all of these other things. The nice thing with being an advisor is you get to take this completely off someone's shoulders. They don't need to worry about it. You just set it up, you run with it. If you're doing it yourself, there is some complexity. But what I'll say is, I would normally say the 80-20 rule is in effect, but it's probably more like the 95-5 rule is in effect here. As long as you get the basics right, as long as you're generally in the right ballpark in the rough amount of risk that you have in your portfolio, and you're not doing anything too insane across the entirety of your retirement plan, you're actually probably okay. As long as your spending goals kind of match up with your liabilities, or spending goals match up with your assets, you're going to be generally okay. There's a lot of kind of optimization and tweaking that we can be doing here. But so long as you get the basics in place, you're in a really good place. You're certainly in a better place than the vast majority of other people out there. What we really want to focus on is getting those basics put together and getting those building blocks in place and helping you understand what that actually means. And then once we do that, then we can go in and talk about those tweaks and some of those more advanced type of strategies, but you don't need them.
Mm-hmm. It sounds like if you're starting with RISA and the focus of everything you laid out there seemed to be about retirement income, that screams to me that retirement income is the most important element of the strategy. And then do you later get to healthcare strategy, tax strategy, estate planning strategy?
Oh, absolutely. And it's absolutely going to be very, very kind of client specific or individual specific, I should say. So we start with retirement stuff because for the vast majority of people who are thinking about this, retirement is their big goal. But, someone who, I'm in my mid 30s, my daughter is in her freshman year of high school, for someone like me, college planning is probably going to be the most kind of salient near-term financial issue or the big picture financial issue. Well, that's what most people would start focusing on. And that's fine. Someone who knows that they have significant health issues that they need to be planning around. Well, you can talk about the semantics here, but, they're going to be focusing a lot more on healthcare planning or health planning, I should say. If someone knows that everyone in their family has lived to like 110, Well, now we're also going to be talking a lot more about longevity type of issues. It's always going to be very client-centric, or very individual-centric, I should say. And it's really going to come down to, what are the things you're thinking about? What are the things that actually matter to you and keep you up at night from a financial perspective? Solve those first, and then you can move on to the next set of issues.
Now, you had a tremendous amount of experience in the investment world before you joined Retirement Researcher, and a lot of that came from the dimensional funds space. In joining Retirement Researcher and really aligning yourself with Dr. Pfau and Alex, what have been some of your biggest takeaways from spending time with those two?
How little the investments actually matter. You got to get them right. You got to do everything the way it needs to be. But, coming from that mutual fund background, everyone's focused, as they should be, on that last basis point, on making that, 3 basis point difference in securities lending or whatever it might happen to be. Now, don't get me wrong. I want that last basis point. I want the fund to be, 1 basis point cheaper. Of course, why not? More money is better than less. But that's not the limiting factor for most people. The limiting factor is, what's your savings rate? How much are you planning on spending? What's your tax strategy? Do all of these things kind of sit together well? Is there a plan? And that's really the limiting factor there. That's what's truly meaningful for people doing their own financial planning.
When you and Weade and Alex, I know for me, our leadership team, we all see things a little bit differently, even across the advisory team. And that results in some conflict. I mean, good conflict, disagreement. Yep. And I'm curious, with you and Alex and Weade, when you three sit down, where are those conflicts? Where do you three see things differently?
Yeah. So I think in terms of the differences, a big one is actually on the investment front. I'm pretty adamant that, markets are, for all intents and purposes, efficient. You can't look at the PE ratio or, whatever other valuation metric you want to pick at and be able to make any meaningful predictions about what you should be doing with your investments. To pick an example, Weade, he does think there is some value there. And that's something Weade and I have gone round and around on a couple times. That's probably one of the big ones. The other ones really are going to be more, I think, also the value of mental accounting. I tend to discount the importance of mental accounting. And mental accounting is, you actually mentioned this earlier, how you think about your portfolio in terms of the different goals. So you have this bucket for your longevity goals or your legacy goals or whatever it might happen to be. I tend to prefer to look at things at a holistic level. It's one big pot of money. How are we divvying it up when we're pulling it out? What's the overall level of risk that you want there? Alex is someone who very much does like having that mental accounting in place and thinks it adds value for a lot of people. Sure, I can definitely see how it does, but it also makes your life a lot more complicated in terms of having to track all of these different things, when at the end of the day, it really is just a big pool of money.
Well, it's a big pool of money, and yet it's supposed to serve a lot of different purposes. Yep. And for many individuals, if you're working with someone and you want this big pool of money to satisfy all these different needs, how do you explain that to them without some type of mental accounting?
It's hard. You're absolutely right. And this is one of the reasons I'm not an advisor personally. So, but the way I think about it is you have, this set of liabilities out in the future, and you figure out what that's going to look like. And then you build a plan that will allow you to meet those liabilities. And, some of that is, take your legacy goals. Generally people with those legacy goals, it's not money that you need to spend. They feel more comfortable taking some more level of risk there because, well, if my kids don't get exactly what I'm looking for, oh, well, if they get more, awesome. Why not? I kind of see that as, well, that would be something that would tend to push up the level of risk that you're comfortable with in your portfolio. It's just another liability in the pool. So it's something that everyone's going to come at it slightly differently. Some people do resonate with that mental accounting, and that's great for them. I don't. I'm someone who doesn't look at it in that way, and different strokes for different folks type of thing here. So.
Well, I think that's what's beautiful about having these different opinions, and I think that's what's so important. That's what so many people are missing in their advisory team is they don't have an advisory team. They have one advisor, and that advisor sees things in one way. But bringing in someone like yourself that sees things, I mean, there's no. I have to think that you and Weade probably see things significantly differently. I would think that would be where the starkest contrast would be. But hey, it brings a lot of value to the clients to be able to have these conversations with a team that can see things differently and bring in different elements. I want to talk about the blog at Retirement Researcher for a moment. I think this might also help to explain some of these things we're talking about because the blog is titled Occam's Razor. Why have you titled the blog Occam's Razor?
Well, to be perfectly honest, I didn't. It was the title Occam's Razor came from the McLean Asset Management quarterly newsletter. And I think Alex put that together way back when. And it's sort of been a little bit of inertia, how that name is kind of stuck along. But really what it's getting at, and the reason we haven't gone in and changed it or done any rebranding is because there is just so much noise and stuff going on out there. If you go on to MarketWatch or CNBC or, pick your financial media, they got to just fill time to a certain extent. They got to keep your interest because that's what they're selling. And that means that things are a lot more complicated than they need to be. Because investing and financial planning, there's some complexity. No one's going to say the tax code or the regulations around Social Security are simple. But, it's not that complicated. So we can kind of, cut off a lot of that noise, a lot of that kind of extraneous complication and focus in on what truly matters. And what truly matters is building that retirement income plan that fits you, that gets you to where you want to be.
Well, that's my next question was going to be your number one frustration with the financial industry. Is this it, or is there another one?
It is absolutely.
This sounds like it.
No, it absolutely is because investing isn't complicated. Retirement planning, when you really come down to it, everyone knows how to do it. In accumulation, you spend less than you make and you save that money. You do that well enough, you're okay. Again, as long as you don't do dumb things in your retirement income plan, you're probably okay. And you are in a position where you can save that money and get to where you want to go from a tactics perspective. The specific tactics that you're using. Again, so long as you're not doing anything weird, it's probably fine. What the financial media wants you to do is freak out all of the time because they need to sell your attention. You are the product of financial media. They're selling your attention to advertisers. And the only way to keep that attention, the only way to keep you watching is for you to be scared. Or I shouldn't say the only, but the best way is to make you scared. Oftentimes we talk about the fear versus greed roller coaster. When times are good, They want you to be afraid that you're going to miss out. They want you to be afraid that you're going to not buy the right stock and, someone else is going to make more than you. When things are turning around, well, they want you to be afraid that the world's going to end. They want you to be afraid that the markets are just going to collapse and you're going to lose everything. Neither is the case, but that's what they want to be doing. That's how they operate. And quite frankly, if you're telling a good story, good as in correct story about investing and financial planning in general, it's not that much material. There's only so many different ways that you can say diversification is a good thing. You're not going to fill a news cycle like that.
Mm-hmm. Yeah, and I can see why one of your biggest frustrations, as well as mine, would be the fear and greed that is pumped into people's minds and eyes via the financial media. However, on the complexity side, let's make it a little bit more complex. So you wrote an article on buffer assets a while back for a retirement researcher. And here's a layer of complexity, right? It's not well, we're just going to throw it in this portfolio and take distributions and everything's going to be okay. You're going,
maybe I am being a little cavalier here, but
maybe you should have a buffer asset. So talk about this. So what is a buffer asset and when is this a suitable strategy?
Yeah. So what a buffer asset is, well, kind of like the name suggests, it's an asset that you hold as a buffer. And a good way to think about it is, if you're in the distribution phase, if you're taking money out of your portfolio, one of the things that you really want to avoid, if at all possible, is taking money out when the markets are down. If you take a look at it in terms of sequence of returns risk, it's not ideal. For a lot of different reasons. So what buffer assets are is going to be a pool of assets, a bucket of assets that you just hold in cash or something very, very stable, where that's what you're actually spending out of. So when you go to take out your distribution for the year or quarter or whatever it is, however you structure this for your own plan, you take that money out of the buffer assets. And then you refill that when things are going well, when the markets are up or above, whatever rule you've set in place for yourself, then you can go in and refill that buffer asset. When markets aren't cooperating, you don't. Now, this does a couple things. First off, the big one is it does create that buffer. And what this allows you to do is kind of just wait out whatever the market is going through. And you can set up these buffer assets however long you'd like. So, if you have a really short one, you might run through it. If you have a really long one, then you give yourself a little bit more runway to kind of wait out whatever's going on in the market. So it can be a really, really powerful tool in terms of, kind of making yourself a little bit more resilient to the market, if you will. And, you can do, and as Casey's mentioning here, I did some work kind of looking at, how big of an effect, how long of a runway do you need? What do these different things look like?
You mentioned the strategy you just mentioned sounds like the working capital strategy, right?
Basically.
You talked about two different ones in the article, the reserve strategy and then the working capital strategy. Here you mentioned the working capital strategy, and I wrote about these two in my book. And when I title these, and this is one of the biggest problems with the financial industry is because they call them so many different things. The reserve strategy, I think of that as a flexible withdrawal strategy. We're going to take our income from the investments, and then we will come over and take them from the reserves if the market's down. Then you have the working capital strategy you just mentioned, which is more of I would call that a bucket approach. We have our first bucket, which is our safe money. We're going to draw our income out of there and let the other dollars go through the ups and downs of the market. So are those two different approaches?
Yeah. So And you're absolutely right. This is one of the biggest annoyances, I guess is the right word, in this space, that everyone uses the same words for about 5 different things, all completely interchangeably. So you're absolutely right. So the other one that is more built around that flexible withdrawal strategy, where you take the money out of, this bigger pool of assets, your reserve assets, when the markets are down, is also a very, very good strategy.
So what are the pros and cons between these two? I mean, how do you determine which one's right for you?
So the big con of the kind of flexible strategy is that you need to start with a bigger pool of money, because, you're setting it up as, here's all of the bad year money that I'm going to have, or the rainy day money that I'm going to have for retirement, all at once. So you've got to have this really big or moderately big pool of assets sitting off to the side. It does give you a lot of flexibility because, as I said, it's not just for a bad market, it's any rainy day type of event. But, it does need to be a bigger chunk of your assets, a bigger chunk of your net worth sitting off on the side, earning, cash-ish like returns, something very, very conservative. On the other hand, that working capital type of approach, you don't need as much. That's something that is working capital. It's just going to be rolling through. But it probably isn't going to be providing as much of a buffer if we have a prolonged downturn, say, right around, the 2001 type of crash, where that was a couple years of, after the first year, not horrific returns, but certainly not fun returns either. That is a period where if you didn't have a pretty big pool of working capital, a pretty long period of working capital runway, you might have spent through that and then started having to eat into your investment type of account during those not so great years, after you've already sustained all of those losses. So it's really going to come down to, kind of which one sounds better from that description. That's always actually something that in all of these different trade-offs, your first reaction matters. We always talk about discipline, but discipline comes from somewhere. So you got to be comfortable with whatever approach you're going to use. The more concrete type of things that you want to be thinking about really are going to be, how much of my assets am I comfortable setting off to the side? What other stuff am I going to be thinking about for that rainy day fund beyond simply market return type of stuff?
When isn't that changed? I think even this has changed quite significantly over the last 18 months, right? It used to be, well, I didn't want to put that much in a safe bucket because it's going to earn 2 or 3% if I'm lucky. And now we could fill a 5-year income gap or a 10-year income gap and get 5 to 6% and not take on risk. And I mean, maybe we're doing that with a bond ladder, but I mean, look at what treasuries are paying, or look at what we can get with a fixed annuity or an index annuity or a median annuity today. I think that's changed the way that individuals are looking at this quite significantly, where they go, okay, I am willing to set more aside.
Absolutely. The cost of capital has changed. So that absolutely.
I think one of the biggest challenges with the flexible withdrawal approach, or the reserve approach, as you call it, where we're setting aside a bucket of cash, maybe it's 2 years, 4 years, whatever it is, we're setting aside a bucket of cash. And today it doesn't need to be cash, but we're setting aside some dollars to be that safe bucket. So if the market's down, we can stop taking distributions from those investments, those at-risk assets, those equities typically, and switch on over to our safer bucket. I think the biggest challenge in that is a challenge we don't have when we look at the bucket approach. As you just mentioned, we're going to spend this reserve. We're going to spend down this reserve bucket, and we're going to replace it every year, every couple of years. Periodically, we're going to start siphoning dollars from that equity bucket and refilling bucket number one. But with the flexible withdrawal approach or that reserve approach, you've got to figure out, when is that time that I stop drawing out of my investments? Is it when the market's down 2%? If is in the market's down 10%? How do you coach people through determining when it's time? So I think people are going through this right now. They're going, well, the market's down 20%. Should I stop taking money from my equities and switch over? Or maybe down 20% is not that bad. Maybe down 15% is not that bad. It could be worse. And I should take it out of that investment side.
So I apologize. I don't have the numbers off the top of my head here, but one thing to remember is that, a year or two down is not unusual. A 5% drop in the market isn't particularly unusual, but it's not that common either. You don't want to penalize yourself by saying, 20% down, it's not that bad. Yeah, it is. That's not a normal thing. 1 or 2% down, completely normal. And one of the things that you've probably seen, I write a lot about when the financial media is freaking out about, the biggest drop in, the past year and a half or something, as if that's meaningful. It's not. But, these big events, when we are seeing down 10%, down 15%, that is the time when you want to be spending out of your reserves, out of that kind of rainy day type of bucket. But, what I'm trying to remember off the top of my head here, but over the course of a retirement lifespan, you're talking about, call it 10-ish years where, we do have those significant-ish market declines, and that's 1 out of every 3 or 4 years, if we're calling it 10 years. So, you don't need to be too precious about using that rainy day money. If we're setting it aside, it needs to kind of earn its keep. If you're going to set it aside, you need to use it when it's appropriate. Now, everyone's going to have slightly different definitions of exactly what that means. Is it, if the market's down at all, I'm going to spend out of there. I'm going to wait till it's down 5%. I'm going to spend out of there. But anything more than that, it's just kind of holding it there to hold it there. And that can be fun. If you're going in very explicitly saying, that's the money that I'm never going to touch. That's my, everything's gone bad type of money. Sure. If your plan can sustain you, if the rest of your assets can sustain you by while still having that money in, a lockbox, if you will, that's great. But if we're using a reserve type of strategy in terms of those buffer assets, then use them. We don't need to hold it. It's not doing you all that much good just sitting off in the corner unless it's actually doing its job.
Yeah. Well, let's talk about some of these different vehicles. You mentioned a handful of different vehicles that could fill that reserve or that working capital bucket in the article, some of which you haven't mentioned yet. So kind of run through what some of those options are when we're looking at setting aside some safe money.
Yeah. So, basically it's going to be anything that is cash-like. So it could be literally just a money market fund. That's perfectly fine. It could be, a short-term treasury fund. You may also be, especially if you're looking at it in terms of kind of that longer-term reserve type of asset, maybe TIPS or I bonds or something that's more explicitly inflation-linked. Though, short-term bonds do have pretty solid correlations with inflation in and of themselves. But really the goal is just not to lose stuff over there, not to lose money in your reserves. It's supposed to be this separate pool of money that's just always there. And it's not exposed to the same issues that we're seeing with the market, because that's there in case the market goes down. And I'll also call out, if you look at TIPS right now, they've gone down pretty significantly, or at least the intermediate term TIPS that everyone tends to be using, because they're bonds. If the bond market is down, TIPS are also bonds. They're going to go down as well. They're going to have that inflation protection on there, but the bond is now less than or worth less than it used to be.
Well, I can tell you're the director of investment analysis over at McLean Retirement Research. Again, it's so interesting because I get such different answers from you versus Weade around these same exact questions, which is why I wanted to bring you on. And I think somebody else had a little input in that article in addition to yourself. You mentioned in the article, reverse mortgages and cash value life insurance. I'm thinking,
absolutely,
Weade inject himself in there.
Well, they're not. So when I'm sitting down to actually think it through, I come up with those answers because they absolutely are. Because a reverse mortgage or any sort of line of credit type of vehicle can be really.
Well, I didn't notice in that you said a line of credit from reverse mortgage. You didn't say a HELOC. You said a HECM.
Okay. Yeah.
Right. Why would you say a line of credit from reverse mortgage and not a traditional home equity line of credit?
I would have to go back and look at the article again. It could have just been, in all honesty, an oversight there. But it's really getting at how do we get access to this money in a way that's uncorrelated from the market? Because that's really the goal here. How do we get access to money that we can use that isn't impacted by the market going down?
Well, let's talk about the market a little bit. Let's go ahead and do that. All right. We'll talk about the investment side of things. So let's talk about today's economy a little bit and specifically on inflation. You wrote an article earlier this year. So this is quite a while ago, several months ago, you wrote an article on inflation and the impact it's going to make on retirees. But in that article, you said we're likely to see high inflation stick around for another year, and we'll see it drop in about 3 years. Given how quickly the economic landscape is changing and everything that's happened that I think many didn't see, do you still hold that same point of view? How do you adjust your assessment of inflation and interest rates today over what you saw 6 months ago?
So I have zero opinion of this in and of myself. What I look at is, what is the bond market telling me? And actually, what's the TIPS yield telling me? So the best way to get a sense of what the market expects inflation to look like is look at the difference between the yield on a treasury bond and the yield on TIPS, because that difference, I guess technically a normal treasury bond is slightly senior to a TIPS bond. I think they're 1 and 2 in terms of seniority off the top of my head, but that difference in credit risk is so minute it doesn't matter. So what we're looking at there is how the difference in those yields is how much investors are willing to pay to get rid of inflation risk. So they should be willing to pay basically however much they expect on average inflation to look like. So the difference between the treasury bond and the TIPS yield, we're still seeing that same sort of pattern. We're still seeing, I haven't looked at it this morning, but we're still seeing relatively high inflation in the nearish term, and coming back down to much more normal levels over the longer term. So if we're looking at say planning out our spending throughout retirement, long-term inflation levels, long-term average inflation levels are still at, call it 2.5%, 3%, depending on exactly the time frame you're looking at. So we're still seeing very, very normal long-term inflation type of levels here.
And how do you see that impacting the stock market? And what I don't know that everyone really fully understands the intersection of stock market performance. Well, add to that stock market, the economy, and inflation and interest rates, right? There's all these things that are really filling the news over the last 6 to 12 months. And I think that's further overwhelming or confusing the average investor. I mean, it's confusing for us.
Absolutely. It's confusing for everyone. It should be confusing for everyone. We're combining literally every piece of conceivable information into one single number, which is the stock price on, whatever stock you're looking at, or, what the levels on an index are. So there's a lot of stuff happening. And, as we all know, the stock market is a little bit volatile. which means there's just so much noise and randomness in here. So when we're thinking about, let's take inflation in terms of what that's going to do to stock prices. Well, one of the things to think about is inflation is one of the inputs in terms of what a stock's expected return is going to look like. The higher inflation is, the higher that input is. All else equal, higher levels of inflation probably are going to suggest that, the stock's expected return or the market's expected return more broadly is going to be higher. Now, there's so much noise in there that it's kind of hard to see that on a day-to-day basis, especially as we're seeing changes in that level, which is what we really key in on. But over time, stocks are actually one of the best inflation hedges out there, meaning that as you have higher inflation, stocks are going to be going up moderately, roughly, sort of, kind of in line with that over time.
Mm-hmm. Yeah, and I think that's in line with one of the questions we had from one of our weekend reading subscribers. Ryan asked, the Fed doesn't appear to be done raising interest rates. With rates moving upward, should we start looking into safer investments? Or do you believe the stock market will make a big rebound? If you believe the market will rebound, when do you think that will be? Crystal ball time.
So, yeah, I have literally no clue what the market's going to do over any non-lifetime type of time frame. What I would say is think about how comfortable you are investing for the long term. Looking at where the world is right now, looking at where everything is right now, are you comfortable investing in the market for the long term? If yes, great, there you go. If no, well, then don't do it. And, there's obviously gradations in terms of, what sort of asset allocation are we looking at here? But that's the big question. We have no clue what the market's going to be doing over the next year, 5 years, 10 years, whatever type of, short-term type of time frame. And 10 years is short-term. So don't worry about it. If you're going to be looking to spend in that sort of time frame, then you want to be a little bit more careful. So I know this isn't the most satisfying answer in the world. Unfortunately, it is the answer.
It's okay.
We just have no idea.
I think it's very insightful, though. And many may not know this, but I know you're a chartered financial analyst. I know what it takes to become a CFA. And that's essentially, to me, that's a doctorate in investment management. And the level of work that goes into that isn't a far cry from that. And if not, it is. And yet, people want to make a prediction, right? We've got someone that knows this stuff like the back of your hands. You live and breathe this every day. This is all you really do. This is your main focus for a living. And yet you say, I don't know what the market's going to do in the next 12 months, the next 5 years. But then many will look at a financial advisor that doesn't have the level of experience as being a CFA or actually looking at doing investment management every single day, day in and day out. And they expect that person to be able to tell them what the market's going to do over the next 12 months and pivot today to what will some say, 6 months ago, you should have seen this coming and you should have made some changes, right? Well, whether it's a financial advisor, an investment manager, or someone that's got a doctorate in investment management or a CFA, it's so insightful for you to say, I don't know. And that's so frustrating. That's so frustrating for individuals to have to deal with that, but it's the reality.
Yep. And I appreciate you calling that a doctorate because I'm the least educated one of the three of us between Alex and Weade. They both got their PhDs and I don't. So.
Yeah, well, when I look at the three, we go, hey, we got 2 doctors. We got another pseudo doctorate over here.
Yeah, exactly.
Right? So I definitely see that. Well, as we come to a close here, I want to talk a little bit about your family. Sure. You're married, you've got 2 girls, 9, 14 years old.
Yep.
And I'd like to know, first, from a marriage standpoint, how do you work on your finances as a couple? Do you have any practices that you leverage as a couple to manage your finances and stay on the same page?
Yeah. So the first thing I'll say is, in terms of kind of investment and kind of financial styles, my wife and I are complete opposites. If you look at us in terms of the RISA, I'm very much pegged towards the optionality and probability type of time styles. I'm very much kind of in that total return type of quadrant. My wife is exactly opposite. She likes the safety first. She's comfortable locking in solutions. So there's always that sort of negotiation. And I should say, actually, we haven't actually run the numbers, so I can't say this for certain, but it is extremely common that you have couples who have vastly different styles. Mm-hmm. That is completely and utterly normal.
Which is a challenge for a financial advisor as well as the couple is to, how do we manage this? And quite often it shows up not just in retirement income standpoint, but one wants to leave money to the kids, one doesn't, right? Yep. There's a lot of this.
And a lot of it is, there's no compromise on some of these. Some of these types of things are binary choices. For instance, that example there, do we plan on leaving kids or money to the kids or not? Or is it they just kind of get whatever happens to be left over? So it's always going to be that negotiation. It's always got to be that conversation to try and sort out, okay, what works here? How do we find these creative solutions? And it's just talking and making sure both partners are engaged. And, there's unfortunately no real shortcuts here.
And you and your wife having these conversations, how are you incorporating this into your daughter's education? What are you doing to help ensure that they are financially savvy at the end of the day?
We're starting to have some of those conversations, especially with the older one. But it's really, it's kind of, that's a hard question. I don't know that there's a good answer in all honesty. Just kind of, so for instance, myself, my father's actually a finance professor. So I grew up being lectured about my discount rate. If I was being lazy in high school, well, he would talk about how my discount rate is too high. And I need to think about that. I haven't gone quite that level with my daughters, but it's something that you kind of want to just be instilling how to think about the world, how to think about what's important to you, and how do you kind of plan for the long term there. And, that phrase has got a lot of kind of big ideas behind it, but just kind of, think strategically, I think might be a better way of phrasing this. So you have this goal. How do you get there? How do you think about reaching that goal? And I think that's probably the right way to be approaching it.
Mm-hmm. So having these ongoing conversations around goal setting and how to achieve the goals that you have, specifically financially.
Yeah. Not as much financially when they're, coming out of middle school and beginning to get into high school, but yeah, I think that's probably a good way to approach it. That's certainly what we've been doing, kind of just that, hey, focus in on what is actually important and what you have some agency over. What are the things that you actually are able to be doing here?
Mm-hmm. Well, let me wrap with this question. It's been a great conversation. Let me wrap with a very philosophical question, and that is, what does retire with purpose mean to you?
It means that you get to decide what it is that you're doing here. It means that you get to design the retirement that works for you. And figuring out how do you achieve that? There's a lot of people who just sort of fall into retirement, either because I'm 65 now, I guess it's time to retire. Let's see what I can spend every year. What retirement isn't something that should just happen. Retirement planning isn't what's left over at the end of your working years. And then you make that work. Retirement planning is something that should be very intentional. Nothing should happen by accident. And you want to build that in as much as possible. Now, I'm saying this knowing everything happens by accident. Whatever plan you put together, that is not what's going to happen. But we need to act like it is. We need to put ourselves in the best position to deal with whatever is going to be coming our way throughout retirement. And that's what that purpose means. That's how we do this here, because that's all we can do.
Awesome. Well, Bob, thank you so much for joining us. It's been a great
Thank you.
conversation. Look forward to doing it again.
Great. Looking forward to it.
Thanks, Bob.